Fantastic. So good afternoon, everybody, and welcome to our webinar with Dhirendra Kumar, the mutual fund guru. I've learned plenty from Dhirendra over the last 15 years. 15 years ago, Dhirendra asked me to write for value research, and I have to be honest, I don't know how useful my pieces were, but his inputs on my writing were very useful. I remember several sessions with him in the suburbs of Delhi, where he taught me about writing, about how to write in a way that the public actually wants to read. So thank you so much for giving me a start in the world of business writing, Dhirendra. Let me do a bit of a
Thank you.
formal.
Thank you, Saurabh, for
So,
having me
formal
here.
introduction. Dhirendra is the founder and CEO of Value Research. For those of you who haven't come across Value Research, this is India's leading independent mutual fund provider, right? Mutual fund pe data milna, NAV data, fund performance data, fact sheets, right? Way back in the 90s. Virendra graduated from Delhi, University of Delhi in 1990. And remarkably, right through his university days, he used to write in newspapers. I remember seeing some of them before I migrated, before my parents migrated to the West in 1991. He was already writing in 1990 whilst at university. But right from the 90s, Dhirendra has been collating data on mutual funds. As I said, performance data, NAV data, and his firm now is the largest provider of such data. Almost all the mutual funds are, I'm sure, clients of his. And in parallel, they publish magazines such as Wealth Insight. Basically, the Mutual Fund Bible is published by Dhirendra Kumar and Value Research. Naturally, with this sort of authoritative knowledge on mutual funds, as you would expect, the regulator reached out to Dhirendra many years ago. I had the privilege of serving alongside Dhirendra on the Mutual Fund Advisory Committee. But leaving aside MFAC, we were just discussing there is very little in Indian mutual funds that the government or SEBI doesn't request this guru to comment on. So privilege having you here, sir. Privilege having you
Thank
here.
you. Thank you for having me here, Saurabh.
And I'll hand over to my colleague and Parcelus founder Pramod Gubbi to take it from here.
Thank you. Thanks, Saurabh. Thanks, Dhirendra. So,
Thank you.
as the title of the webinar suggests, we're trying to get a sense from you in terms of how safe are investors' investments in mutual funds and PMSs. I know we've come a long way as an industry. We were just talking before the webinar as well. There are lots of changes, but nobody could have observed this over as long a period as you have done. From even as recently as a decade ago, Indians would blink twice when you talked about stock market investing.
Yeah.
And from there to getting almost what 30,000 crores of inflows a month, almost directly getting debited from their savings accounts into mutual funds. Clearly, the Indian saver is demonstrating a lot of confidence in the Indian financial markets. So if we can hear from you, what has transpired to give this confidence? And for those who are still sitting on the fence, doubting the safety, what can you say to give them the assurance?
No, thank you very much for inviting me. And I'm very confident that this is just the beginning. These are the very early days of Indian investors making inroad, mainstream of market participation through mutual fund. And it is a variety of things which is contributing. And I think people like us, people like you, people like me, we are unable to relate to, every time we think of investment, we think of it in terms of beating the benchmark. Have you done it well? We are unable to relate to a person who is investing 2,500 rupees a month. He has a cell phone. He's investing in extremely sophisticated investment. He has access to one of the brilliant fund managers who has achieved the scale, who is actually facing the winner's curse. Despite that, somebody with his 2,500 rupees is able to accumulate something like 32,000 rupees in a year's time. He has not beaten the benchmark handsomely. But having 30,000 rupees accessible while you are struggling to, or, somewhere, trying to put together those 2,500 rupees. When we talk of these 30,000 crore flowing into markets through mutual funds, we are unable to visualize this individual. These guys are not, every time in the last 30 years, I have been been a watcher of the market for the initial 10, 12 years or 15 years. I've always been a watcher. I'm in the business of looking at everything going on around the markets. And I remember that, 1992, people, investing in India has always been a seasonal affair. 1992, the Pied Piper, everybody followed. Because it has gone up, so everybody followed, and then everybody lost it, or lost patience. First time we achieved, 9,000, 4,000 on the Sensex. It took another 10 years too, and in between, the whole Indian industry underwent a complete transformation. All the old stalwarts were, they died. They could not withstand the competition. That India changed completely. Then what, Hindustan Motor, I remember Hindustan Motor, Premier Automobile, MTNL were part of Sensex. Great Eastern Shipping was our representation of shipping industry in the Sensex, howsoever lousy or tiny it be. So, we are a completely different, we did undergo a radical change. And so what I was saying is that, for Indians over the last 30, 40 years, three decades, 3.5 decades, has been a seasonal affair, has been an opportunistic affair. Either it was an IPO boom, either it was a FMCG pharma, either it was technology, either it was infrastructure. It was a story, too good to be true. People, and eventually when you have such a story, then it is not a great experience for individual naive investor. The end, what you need to succeed in the market is buy low, sell high, and you do the opposite of that: buy high and sell low after you lost patience. For the first time, we are witnessing that here is a person who has a smartphone and has a Aadhaar card, and he can get started in 15 minutes. He's investing in a plan, and this is something which looks like a beginning of the whole affair. Somebody who has been able to accumulate for few lakh rupees, and that makes hell of a difference to his life. He is on, and he is likely to be on. And these are all open-end funds. These are very transparent funds. These are very accessible funds. And the ecosystem which India has built with your UPI, getting the money, giving a 3 clicks, and your mandate is on. Let me just give you a context of what I'm comparing it with. In 1992, there was a great Indian fund which was launched called Master Gain. 1 out of every 20 Indian invested. So it is not that Indians were not excited about market. 65 lakh investors invested in Master Gain in 1992. And, and the population that we had, 1 out of every 20 Indian. And they completely messed it up. It was not UTI. I'm talking of managing that paper process. There was a paper application with a signature given by every person, and UTI had a nightmare, making those collections, because we had physical collection mechanism with RBI, whatever, today the settlement happens differently. In those days, it used to be a physical settlement. People from different branches will get collected, or, will collate at one place. Somebody will verify this, exchange the security, physical instruments, go back, verify, confirm. And after that, for 3 months, they were unable to issue the certificates. Mutual funds used to issue certificates because they were listed securities. That was the only means of liquidity for them. And Datamatics, a registrar company, was the registrar then, and they were unable to do it for 3, maybe up to 6 months. And they did it with a lot of mess up, because there was no quality check, signatures won't be there, address won't be filled, sending the certificates, getting it back. So people were facing this problem. When I checked with the Datamatics guy a couple of years later, when it all settled down, he told me that, this was way too big for us to deal with it in the absence of a computer. He was telling me that if we had the signature card of these 65 lakh people put on a desk, as long as a football ground, it will require 4 people on roller skates to do the transferring. Just visualize the signature verification to validate that he is the person and his signature. It will require 4 lines in a football ground to verify and, do it. Imagine moving from there to moving any amount of money and getting it back in your account. Then let me tell you another story. This is one. I still have some physical shares, and, of the physical times. which I have not been able to, and one of it looks to be very pricey, but it's a complete mess, in a sense that I'm part of a committee which is in the business of helping investors get their instruments back. In Investor Protection and Education Authority, they have a accumulation of unclaimed shares of 2 lakh crore only of the, because right now the incremental problem has come to a halt because everybody has a demat account and everybody has a linked bank account. So you get your dividends in your bank, and your securities are always in the demat account. So this is entirely a legacy issue. This huge an asset, 2 lakh crore worth of assets, which remains unclaimed of the physical arena. And so think of it. This is a problem which the government is struggling to solve it, and we are trying to solve it by and it's a very messy problem, because if you give somebody's asset to somebody else, it's not done. And if you do the validation, he doesn't get it. If you do a rigorous validation that you are the person who's the entitled owner, then I'll tell you the third story in the mutual fund context. In case of mutual fund, how it was made very secure. About 10 years back, there was one ED I used to get at Value Research people, because of my interaction with investors and writing for in the mass media. A lot of people said, put their route their complaint through me as well, or just keep me in the loop as well, just for the sake that I might be helpful. I started getting number of complaints that an old person invested in mutual fund and he was defrauded. And the defrauding was very simple. An old person generally will connect with a trustworthy distributor or a mutual fund agent. He will pick his form, he will get his check, and he will replace his own form with that check. And that was possible then. So when we had these kind of problems, it was discussed in the committee at SEBI before the Mutual Fund Advisory Committee was set up, because all these things were discussed in the Primary Market Committee. And then a simple rule was made that the money to be invested must come from the same person's bank account to whom the investment is being made. And the bank account details will be such that the redemption proceeds will always be directed to that account. That was the end of the story. That is all there to it. So unless somebody is signing a power of attorney and giving authority, it's like giving a blank check. It's like giving your transfer slip to us. So once we have a depository, and now look at the depository, it is all about a very proactive regulator and intermediaries who have worked very hard to make it a flawless system. Today, there was another wake-up call not very long ago when Karvi stockbroking, it actually was able to take shares out of people, their investors' demat account. That was the final nailing of that, that big gap that was left, that a distributor, the broker will have access to your account and he can move things in and out. Now, moving things in and out for clearing corporation settlement has to be from my account, and the proceeds must come back to my account. There is an extra, of course, we need to give an authority to somebody to access my account for the credit and debit of securities or money, but in a controlled way with the guardrails. So I think, it is not that the presence or absence of big laws. It is ensuring that in a very nuanced way, finding the small gap, making sure, because Indians are extremely creative when it comes to finding the smallest gap or smallest loophole and leveraging it completely. And I think we will come across many, many more. When I look at the crudity of this digital arrest and all the nonsense that is going on, I don't know how can we save everybody from everything, which is so baseless. If psychology is against us. We are fearful. We are fearful. We have a fear of missing out. There will be all those behavioral things. But when it comes to actual, somebody stealing my money, I think there are enough checks and balances, and I think by design it is not provided for. You just have to be extra alert. And the way to be extra alert is that don't give your keys to anybody else.
Right. Fair enough. So, I mean, what you're saying is the take up of mutual funds has nothing to do with the fear of the market. It's been more because the system has removed the friction in terms of signing up through eKYC, Aadhaar, mobile phone, and all that. That's absorbed more investors. But
Yes,
suffice to say that you're giving an assurance to people investing in mutual funds and PMSs, because both movement of money and movement of securities, the law and the systems have ensured that it can go to the rightful beneficiary and not other way around.
yes,
That's hugely
absolutely.
comforting, sir. Now moving to the mutual fund itself, like we were discussing, yes, it's become a very disciplined way of saving for the average person. You said that the fact that it doesn't generate returns is secondary. If
Yeah.
it doesn't generate returns, but as long as they see that money accumulating is great. Secondly, even if it generates returns, the alpha is not a priority. The fact that they're giving better than your deposits and so on. Now, the question everybody is asking is the new wave of investors that have come in. I think out of the 6 crore unique mutual fund investors, almost 3 crores have come in pretty much post COVID. And in these 5 years, we haven't really seen a very steep drawdown.
Yeah.
The lack of a steep drawdown, is it masking the innate loss aversion behavior of the investor? Or do you think the Indian investor has become so mature that should say the Nifty fall 30% tomorrow, which means that small cap, mid cap could fall 50, 60%? Have we done enough investor awareness and education that the investor, I mean, these sort of 30,000 crores of inflows will sustain? Maybe they'll go to zero, but you won't see a panic driven selling.
Mhm. No, my sense is that, no amount of investor education works till you experience the market. You have to really see that, you have to see your money achieving a high and then falling freely. And that is the nature of the market. And I agree that most investors haven't experienced that. But at the same time, I would say that many of these investors, they have never experienced the market in the first place. Accumulation gradually. Also, the access, never in the past, I've come across a situation that people were investing entirely in the digital form. People are in their phone is their interface. That is the phone that they use to call, and that is what they are using to invest. And if the market hasn't gone down and they haven't experienced, that doesn't mean that they haven't taken some money off the table. Somebody will be taking some money off from his equity fund for buying his refrigerator in Delhi, in Diwali. It's not unusual. I come across people investing for the long run and taking a small part for the next holiday. It's a very usual thing. We have a very different stereotype. I came across one of my colleagues, he used to work with me, and every now and then I see him on a foreign holiday, and he has been able to crack the whole thing of cheap travel and reason modest, and he is not a luxury seeking person, but he's able to redeem a small part of his money, not breaking his capital. uh, I think we have grown old. We are old fashioned. We think that the money that is for the long run, we don't have to touch it for our retirement or for something some substantial. I think people are experiencing investment and withdrawal and redemption and different things, different buckets. Maybe some of these mutual fund investors, they they graduate to being a stock investor selectively. Uh, and I really like them for that. Your best learning is by trying out, and the earlier you do it, cheaper it gets. If you have to pay the price of learning after you have accumulated something meaningful, uh, it's going to come with a big bill.
Yeah, no, well said. So well said. So now India is unique in the sense the world over we are seeing a gambling culture where people want a quick buck. Instant gratification is what driving most people's decision. While we all glorify compounding, I think that sort of attention span is rare to get. Yet we are seeing on the one hand what you just described in terms of mutual fund investors happy to put away money for the long run, and watch it grow. On the other hand, we've seen a spurt in FNO trading, which at best can be described under the instant gratification bucket. Until the recent ban on real money gaming, we had staggering numbers of investors on those platforms, not investors, rather participants on those platforms.
Yeah,
And
let's just be, very, very candid about it. The punters.
yeah, correct. Punters on those platforms.
Yeah.
What describes this dichotomy in India? On the one hand, people who are saving 500 rupees a month in SIPs, seeing that grow over the long run. On the other hand, you have these punters. I know throughout history, both of them have coexisted, but for India, it's all sort of new. What do you observe from your vantage point?
No, I don't think they have coexisted. They are two different animals. Uh, there are people in India, we should not forget that Indian post offices have democratized being thrifty and savings. If you look at the bank deposit, the small deposit, the recurring deposit, the public provident fund by far remains the largest savings instrument for long-term savers. It might not be a very smart thing to do because you are effectively doing a fixed income investment for next 15 years for guaranteed income, and you settle for that. At any point in the last 35 years, you would have carried on with a similar amount of SIP in Sensex. It would have beaten it by at least 1.5 times on any 15 years, any 5-7 years time frame. But still, people like it. People like the guarantee. People like the safety. People like the predictability. People like the complete, absolute uncertainty. Absolutely, no uncertainty whenever you need it. Your ability to leverage it anytime you want. So in that sense, this large part of Indian, and if you look at, your own grandmothers or my grandmother or my mother, I know that, they always had that emergency fund or reserve somewhere in the mandir or somewhere. Yeah, it came as a big knowledge to me when when the demonetization happened and I started getting calls from various places, various housewives, my own house, folks or relatives or my aunts and grandmom's generation people. And they started asking me कि ये 12 लाख रुपया पड़ा है मैंने बचाया था अब क्या करें अब उसका शादी भी तो 1-1.5-2 साल बाद है it was meant for a purpose and it was not generating return, but who cares? You had the capital where and it was a fallback, it was the emergency fallback. So money has different needs, money has different complexion, uh, and I think we are missing out. The people who are they are actually the people, what SEBI study says. In fact, I need to just give you some interesting information. Most of these modern fintechs happen to be my customers, the grows, and they come to me for mutual fund information. And the funny thing is that I was part of the data advisory committee. I was very supportive, or effectively I was always a voice for the people to whom making these transactions or enabling speculative investment became so easy because of these instruments or Zerodha. Or Nitin Kamath himself goes on his Twitter to say that most of his customers lose money. And then at SEBI for last 2 years, we have been doing this survey. And survey is based on the actual transaction data of the underlying, based on the, the stock exchanges. If we look at this number, 92% of the investors lose money. One must be joking, but that is true. And when I talk to some of these fintechs, where somebody, I had a conversation with somebody last week, and I got a very interesting feedback. He said that 92%, which SEBI says is a very big number, most investors lose money. We are very lucky. We are so good that only 2/3 of my investors lose money. Uh, so, so if you if you have people taking consolation, so I think this is about time where most investors need to be prompted that what is investment, what is speculation, and I think speculation is very deep rooted. Whether it be a Diwali Teen Patti or whether it be Mahabharat or whether it if you and not only that, in India it has a far different connotation. it has a far different relevance and context, which is all other forms of speculation, which gives you which can give a human being a vent to his speculative instinct, is illegal. Only this is not, which also gets the camouflage of doing something with rigor for academic brilliance or something thoughtful. So basically, pretending to be doing something and doing this speculative nonsense, and getting up in the morning and getting to work and you lose some, you win some, and overall you lose it all. So I think, and that is fine. I think the regulators and government should make it some kind of, just like in Bihar we have prohibition because women. Likewise, if we are able to bring in some degree of prohibition, that people below a certain threshold scale, they don't participate in this market because it is very risky. Most people lose money, and if they lose money, it actually hurts your family and the social interest. So below a certain threshold, I think they should not be allowed to, because that is hurting the family. That is, and it has nothing to do with all the rationale which I come across, that it provides liquidity to the market, or these are very important instruments which helps you hedge your positions. I haven't come across anybody who is actually hedging his portfolio from a fall or any such thing. It is naked speculation, position holding, trying to ride, and it's a leverage trade of a kind, which eventually comes to bite you. And by the time you learn, so that is why I keep encouraging that do it early, learn it fast, you will lose less.
Fair enough, sir. It's a natural human instinct we can't do
Yeah.
much about other than having some curbs from the government. You
Yeah.
have the ears of the government and the authorities. Hopefully, you'll do the needful.
Mm.
Coming back to more disciplined investors rather than punters, there also we've seen a certain level of learning curve happening through. What we've seen in behavior, you talked about the fintechs. When we speak to them, they say much of the buying is simply goes towards the best performing fund in the last 3 months or 6 years, 6 months, which is on the
Mm.
direct code on these platforms. And that's also indicative in terms of the flows. Small and mid cap funds have attracted the most amount of flows because they have given the most amount of returns. Now, in your columns that I've read, you've talked about the discipline of asset allocation, putting a framework to this. I guess we're a long way away from people doing it at their end, and we have some really good advisor community, but they can't reach out to the 6 crore investors. Is there something that you can share in terms of what is the framework a DIY investor can use so that he doesn't get carried away from the flavor of the day and yet align his sort of portfolio towards long term, medium term, short term goals, whatever they are?
Yeah, we have a very simple framework. A simple framework which will make sure that people are not disappointed and they don't quit the game in a premature way. And that is something which we have implemented in our RIA service, Value Research Fund Advisor. And the framework is very simple. In fact, if I have to narrate it, I can, how should people allocate? One is that don't worry about allocation when you are getting started. Start anyway. Otherwise, thinking of asset allocation framework to start, that you get another excuse why not to start. Starting to invest is a big task. You are postponing your today's consumption for some future consumption, and ask a 20-year-old where he has all his pent up needs and desires and peer pressure, and then you tell him that you will retire well or you will have something at 40 which is much more. So this is it's a big leap, and it is very natural for people to get tempted and not have a plan, or even if you start with a plan, get off that plan and have some fun in between. Because you're and in this consumer oriented surrounding that we live in, so initially start with something. But if I have to sit across the table, and if I've come across a 20-year-old or a 25-year-old or even a 28-year-old person, he says that I have to invest, I will ask him one question: that what percentage of your money are you able to save. If he says that he is able to save 75% of his money that he earns every month, which most youngsters do because they live with their parents and they don't have much of the the living cost and other things, or they are very well paid. I will suggest him that get started with anything risky, but make sure that you're doing your SIP. If you start with a small cap fund, if you start with a micro cap fund, and if you do it for 3 years, magic will happen. And he will also not panic because 75% of his money is able to save. He has far greater confidence in the future. I will be a little more conservative with a person who is 25, who is somehow able to save 25% of his income. He makes 50,000 rupees and is able to save 12, and in his context, that 12,500 rupees will be far more meaningful. And that person, I would suggest him either an aggressive hybrid fund, which will be 75% equity, 25% debt, or a flexi cap fund or a multi cap fund, any of these. But make sure that he's doing his SIP for 3 years. At least have that in mind, plant in his idea in mind. Somebody who has crossed 30, first investment and investing should always start with an aggressive hybrid fund, SIP, and that kind of time frame. Only once you have accumulated something, which is because the panic hurts, you panic only when the meaningful amount of money in relation to your annual income or monthly income and things like that. If your annual income is 10 lakh rupees and somehow you have been able to accumulate 40 lakh rupees, now this money has become important. Now you need to do asset allocation, so that asset allocation serves two purposes. One is that you get a steadier, it fall less. Second is that you have the opportunity to capitalize on the fall by rebalancing it. Otherwise, most of the fall we regret. I had one of my biggest regret in life for a different reason. I invested in a fixed income fund and I liked it and I had great confidence in that. And that confidence was shattered because at the peak of the COVID crisis, that fund came to a standstill. It freezed the investments. So even then I was not very unsure that this money will go down the tube. My only problem, my biggest regret is that the money which should have been invested in the market, which was meant for reallocation, was not accessible to me. And that is what you are able to. So this asset allocation serves that purpose. And if you can do it with simplicity, it can be done with 2 clicks. And most investors should not do very active. There are some apps which have, come into my attention where they are encouraging a monthly rebalancing. The problem is that, that is the problem. The problem is that once investors have been communicated that this is a good thing, then too much of a good thing may not necessarily be a good thing any longer. For example, mutual funds, it's a good thing, but is having 50 funds in a person's portfolio a good thing? No. SIP and then having 13 SIPs going, it may not be sahi because, and what is happening is most investors end up being an index fund investor and incurring the cost of an active fund just because they own 30 funds, because they own 40 funds, because they have SIP, they have different distributors. And quite understandably, they're extremely vulnerable to the stories simply because end of the day, it's a consumer product. I'm postponing my today's consumption for a future, delight. And somebody giving me a story that, the whole world is changing, EV is going to change the world, AI is going to change the world, and how on earth can avoid it? And then if Saurav comes and tells them that, no, these boring stocks, a diversified stock, a stock, a company with a 20-year credentials, the stalwarts, and they have existed, and this is the thinking which is driving this business. That does not strike a chord. Exciting stories do.
Right. Fair enough. So now I'm sure the clients want specifics. Now you said 50 mutual fund schemes don't make sense, 13 SIPs don't make sense. Is there a thumb rule? I know, you can't take a cookie cutter approach. How many funds, or is it just the number of funds or the variety of funds which will actually add to diversification? Any simple framework?
I have a very simple framework. This is a question which we face at Value Research every day. And I think, and we are also advisors to some of the largest mutual fund investors in the country. Some of them which go beyond, 15,000, 20,000, 50,000 crore. And there we apply the similar rule, how many to have and how many to not have, what is relevant, and even in their context. And those context is relevant even for Indian investors, which is you can build a great portfolio with one fund, which is that aggressive hybrid fund. You have everything in it. Make sure that it has a 10-year history. It has been able to generate alpha for its allocation in 7 of the 10 years. And we have 9 funds of that kind, and 9 in a category of about 40 funds. So you have an impressive category, but they're boring funds. When the market goes up by 5%, they go up by 4%. It's not exciting. They fall little less, and over a 3, 4, 5-year period, they end up being okay. And it's a great choice for anybody. So one fund can do well. Once everything is in relation to what is your scale. Once my first 10 lakh rupee investment becomes 20 lakh rupees investment, and that is equal to my 4 years earning, then I need to spread it over. The reason why I invest in a mutual fund is to quickly diversify. And that is why I need to spread my investment from one fund manager to the other fund manager, because the best of fund manager go through lean period. And if all my money is in with the same guy, I will not feel very happy about it. And that I can tell you that the finest of fund manager with impeccable credentials and very honest, dedicated work backing their initiative or their work every day, very sincere people, they also go out of favor. Their hypotheses go wrong, a small part goes wrong, it is disappointing. So that is why you need to move beyond one fund manager. But maybe 4 fund managers and I can actually build a great portfolio if I don't have an asset constraint. Then the third constraint comes in, which is if I am a fund manager, if I have to invest my money and if I have 20,000 crore to invest, then you have to make sure that you are never a very sizable investor in that fund. I make sure for my very large investor that they are never exceeding 5% of the mutual fund's net assets. That is the third one. But I think most individual investors don't have to bother about it. Then you have these usual temptations, and then some of them are meaningful temptations. For example, I'll just give you an example of that. About 4 years back, there was a fund which was launched, and I was reading things, I was understanding things, and I was getting very excited about AI. And these were very early days of AI. None of the AI apps were still in the market, but I was beginning to understand that what is going on. NVIDIA was at its record high anyway, but at least, at that point, about 4 years ago, NVIDIA was 25% of its current market price. So I was very upbeat about it. And there was no way in India I could be sitting and investing peacefully in that stock. The only vehicle available for me was NASDAQ 100 or the NASDAQ Quality 50. So I invested my money in that. And then a fund came about, which was a more concentrated one, which is that FANG Plus. You could invest in that fund and 10% of your money is spread over these 10 stocks. And that has turned out to be one of my finest investment in last few years. So many a times, this is a fund which at Value Research, I have officially gone and told my subscribers that don't invest in this fund. They may be extremely uncomfortable with it. Soon after my investment, it went down in value by 40%. And Alibaba and Baidu were part of, that Baidu just came, was a misspelled thing. Baidu were part of FANG Plus then. And once they were ejected from FANG Plus about 3.5 years back, that is when, FANG Plus started its whole new momentum and it recovered. But soon after that investment, the investment went down in value by 40% or 30% and was struggling. And then it went up by leaps and bounds to not stop anytime. But at the same time, most investors will be extremely uncomfortable with that 1.5% daily up and down. We don't have the Indian market going up by 1.5%. And here is a fund which is spread over. And I don't have a problem of scale here. Here is a fund which is invested in 10 companies, and one of or few of these companies are equal to the total market cap of the Indian market. So I really don't have a liquidity issue. I don't have, and there is a huge risk. There is a whole bubble which could have been built in the AI space. There are some of these stocks which can go down in value by 50%. Many of these stocks have gone down in value by 50% on many occasions. And I'm not talking only of Tesla and Nvidia or Microsoft. And at the same time, when I look at the moat of many of these businesses, it's very difficult to visualize that, a world without Alphabet, a world without Microsoft, or, how diverse they are. But I don't know. The whole world the world has changed with them, and the world can change without them. So there is an inherent business risk. There is an inherent weather risk, or the whole climate around all these businesses. So you can achieve it, a meaningful, good, high quality portfolio of a sizable scale with adequate representation, and even with some tactical exposure to some of these, or tactical temptations, which I may say. Because in 2000, when the first technology fund was launched, that was also one of the most interesting tactical exposure before, these technology stocks or the companies. Because, I remember all those times when everybody used to say that this Infosys wala and all these fellows will one day run away with the money, and all their assets gets depreciated by 25% every year anyway. And so they don't have a factory, and it's a very risky thing, and something which went on to become a sizable business. And of course, we have a story which we should not forget, that Infosys was a great company in 2000, and Infosys remains a great company in 2025. But from 2020 to 2010, the company didn't make money for the shareholders, because you just caught the high. And we could well be, and that is why you need to diversify. That is why you need to diversify over style. And I think all these goals can be achieved with 4 or 5 funds.
Absolutely. No, that fixed income getting stuck was eye-opening, because, like you mentioned, asset allocation is not only important to reduce the volatility, it gives you an opportunity to rebalance into the drawdown with some
Having
dry
resources at the
powder
right
in
time.
an uncorrelated asset class. I think not much is said, and I don't see much appreciation in the investor community. I think if you keep writing those columns, and I'm sure someday it will dawn upon. In fact, it was brought to my notice that one of the largest flexi cap funds in India and one of the largest multi-asset funds in India have the same 20-year return. Because it's hard for most people to fathom, who actually believe that equities is the best performing asset class in the long run. And they say that, look, I'm seasoned enough to go through drawdowns, and therefore don't give me any other asset class, this asset allocation. But what we keep telling those is that, look, it's great to not panic in that drawdown, but that's not enough. You should be able to take advantage of that drawdown. So if you don't have dry powder in another asset class, you're not doing the best you can. So no, thanks for bringing that point about. I'll hand it over to Saurabh if he has any more questions, or we can open it up to Q&A from investors. Folks, if you can just type in your questions in the Q&A box, we'll try and take as many as possible.
I think the questions in Q&A box are piling up. So I'll just quickly get one question in, Dhirendra. Dhirendra, you explained beautifully how the mutual fund industry has been designed to protect our clients' assets. And hopefully, as and when we have a mutual fund, we too will be able to benefit from that. In the PMS construct, right? In the PMS construct, right? Could you explain to those who are watching and are interested how the PMS industry actually has a similar construct, where client assets actually are kept in a way which is very difficult for anybody, including the fund manager, to do anything naughty with?
Yeah, in fact, I'm very impressed by the most of the time, regulators and government agencies, or the people who frame the rules, they are pretty broad about when framing the rules that broadly do this. But when it comes to many of these things, SEBI has been extremely proactive. The way they have devised that you everybody must have you actually have access to his demat account, and the and the custodian structure that you have, that the custody of those securities will be with somebody, and that is not accessible, and that is linked to the your contract binds you to not have access to. If you are a PMS provider, if you are a PMS manager, you don't have access to those assets. You only have an access to manageability of those assets. You can control those assets, move the money around, and you really can't move that money, move those securities from there to anywhere else. So in our case, I'm not talking of Bernie Madoff or somebody, who was just giving you some account statement. But I'm thinking that what happened 5 years ago with Carvey, I don't think it is possible to do it today. Nobody can move your securities from your account without the purpose. And in this case, um, I think we have enough checks and balances, unless somebody is hell bent on defrauding the investor,
Right. And folks, I think
which
this is
amounts to faking the signature or
uh,
gaining access to the phone.
absolutely. So I think this point that Dhirendra is making is worth appreciating. Several of you have questions. I think Anupam Parashar has a question about the benefits of PMS over mutual funds. But on this subject, right, protecting client monies. So I think SEBI has done a great job both with MF
Yeah,
and
so Saurabh, I think you yourself will be better placed to explain the exact mechanics that the money comes to the demat account when you buy and sell. What exactly happens? Where does the custodian comes into play?
absolutely. So folks, just to sort
I
of
think your explainer will be more nuanced.
just to take a cue from what Dhirendra is saying, there are two types of PMS constructs. One is a PMS which says every client's assets are segregated. So Dhirendra's portfolio is separate from Pramod's, and Pramod's is separate from mine. And all that the PMS fund manager can do is buy and sell securities inside Dhirendra's portfolio, inside Pramod's portfolio, and inside Saurav's portfolio, right? It's very difficult for the PMS fund manager to pull money out of Dhirendra's portfolio and enrich himself. The SEBI construct, the custodian construct, makes it impossible to do so. In fact, the fund manager doesn't actually have Dhirendra's money. If a fund manager doesn't have Dhirendra's stocks or money, it's with the custodian. The
And
second
the dividend gets into my account.
the dividend gets into Dhirendra's account directly. And once again, remember courtesy, NSDL and CDSL, people like us are able to give username and passwords to our clients. The clients can check every minute of every day that they want that their paisa is secure. The other type of PMS construct is a pooled account construct, where say many PMSs, including Marcellus, we pool our clients' money in one account. We are simply operating the account. We cannot take money out of the account. The account again is with the custodian, and in that pooled account, we say that look, for Pramod, for Dhirendra, for Saurabh, buy X amount of Asian Paints, Y amount of HDFC Bank, Z amount of Titan, and again the fund manager cannot take money out, right? So it's a lot of people over the years have this misconception that somehow in the PMS their money is less secure than mutual funds. That for better or for worse, I would say for the better, is not the case. Both PMS and MFs have made your money extremely safe. Right now, let's address this broader issue. Right, this never-ending question: कौन सा बेहतर है, PMS बेहतर है, MF बेहतर है? Right? What would you say are the two or three big pros and cons of either on either side, on PMS and MF? Both have existed now for mutual funds have existed since 1962, and PMS I think has existed since 1992 or 93. So 30-40 साल हो गए हैं both formats को. So both must have merit, otherwise they wouldn't have existed so long. So what would in your mind be the two or three big positives on either side of the PMS MF divide, Dhirendra?
No, it's pretty straightforward and obvious. But and of course, mutual funds have existed since 1963, 64, but that is notional. The first closed-end equity fund started in 1986. Then the first open-end equity fund where you could buy and sell every day based on daily NAV, that started in 1990, no, 2000 1993. That is the 1992 was master gain, and that is the time when Morgan Stanley also started. So Morgan Stanley and Pioneer ITI, Kothari Pioneer. That was the beginning of the daily transaction-based open-end equity fund. So it's very recent. And that also was notional. I'll tell you, my first SIP actually went with the post-dated checks, 12 of them. And the bankers were not very generous with those issuing those checks. The settlement was very complex. But mutual fund and PMS is very simple. When you invest in a mutual fund, all the short-term gains and losses, they are to your account, and that has to be squared up, and you are liable for the taxes. Whereas this is one advantage of mutual fund which goes unnoticed substantially. When you invest in a mutual fund, you invest your 5,000 rupee or 5 lakh rupees or 50 crore rupee, and the fund manager is, doing active churning of the portfolio, generating short-term gains, long-term gains, or whatever, buying and selling things. Till you sell your investment, you are not liable for any taxes. And your rate of taxation depends on your period of holding. So this is one advantage which is significant. Second is, the convenience, 500 rupee. The PMS fellow will not talk to you for your 500 rupees investment. It's not possible. What is the minimum now? It is 50 lakh rupees. Yeah, so it's a small guys, and then 500 rupee can be invested in any professionally managed diversified portfolio at will, on demand, at any time, and your ability to the whole ecosystem has evolved. So transparency. Third is that they simply have large number of investors. They are under public scrutiny all the time. Assuming that mutual funds, they do something. Every day I come across every mutual fund being scrutinized so intensely. Like most of the time, I don't have to research at value research to figure out what is going on. While I was just trying to look for the link to connect to this webinar, I came across that one leading fund company is launching a large cap fund, and that fund company had a very prominent multi cap fund or a flexi cap fund, and that flexi cap fund has been 95% into large cap anyway. So people are questioning that why do you need to launch another large cap fund when you have your existing fund, which is a very sizable one with a great credentials, with a great track record. So I think under very close scrutiny, large and economies of scale. When I look at the fee on these scaled up investments, it looks like a steal. Some of these larger funds are available at 50 basis point, which I don't think will be possible. So unless you come across a PMS which has a compelling story, unless it is telling you something which cannot be achieved elsewhere. Otherwise, if you have your essential needs, which is participation in equity to diversify, participation in equity to diversify to generate alpha, participation in equity to diversify, which is well regulated, and it'll get you meaningful return, or alpha and beating in over a period of time and with convenience. I think on those fronts, it's very difficult to match mutual funds. But when it comes to something which otherwise is not accessible to an individual, something which is very much tailored. I was telling you about this Fang Plus, and I was reluctant to invest in Fang Plus till it had Baidu and the other Chinese company as part of the index. So I was just if you have any such mental quirks or preferences and other things, so in that sense it is my portfolio and my ability to like or dislike and have my preferences, and that getting reflected in my investments. PMS can have a role, but I think the PMS, the way it has made inroads, it's ever since the mutual fund got democratized and the pricing got structured, there is a large army of very sophisticated salespeople in the marketplace, and they need to sell something with a high margin, which is relatively less regulated, which is lightly regulated, and it is relatively an easy sell too sometimes. More so in a rising market, things are easy sell anyway. And in fact, the ones which actually take the greater risks, they do deliver more. And for a long period of time, it could be an easy sell. You can simply show the numbers that here is a fund which is doing better. And uh, but I think it will come to haunt you, or maybe investors are not able to, because there are very large investors whom are who are accessible to some of these salespeople, uh, the wealth managers, and they are able to pitch those things very convincingly, and some of them win, and unless there is some substantial advantage. But when I look at the a long period of time, 5 years, 10 years period, methodical investment, the scale of investment, the brilliance of the fund manager, the diversity of fund managers, my ability to get out anytime, my ability to get in anytime. I think, it's very difficult to find a compelling selling, unless I come across a compelling performance which is sustained and is explained and it's transparent. Uh, I think the case for PMS is relatively weak.
So there we have it. So Dhirendra, folks, he has written a superb book. So I found this 6 months ago. He published this, I think, June this year. So the book is called Money, Markets and Mistakes. Money, Markets
Thank
and
you, Saurabh, for
a guide to
growing
investing
it.
clarity. The reason I'm highlighting is इसमें NPS भी है. इसमें
हाँ,
NPS भी है. Folks, don't forget NPS. I'm a big NPS fan. And इसमें cryptocurrency भी है. Right? So don't forget cryptocurrency as well.
जी
So
जी.
plenty now on everybody's plate, right? We investors like us also offer a global fund. We have a global compounders product. So
Oh, I really, I'm a great fan of that fund, because and that is a novelty for me, because if I want to really access this market, I have no other legitimate framework except for this, and it
बिल्कुल.
eliminates the need for me to go to the bank and first turn my rupee into dollar, look for a broker, and make sure that my accountant gets the right statement every year, so that I'm not really, losing my sleep on that. So I think, there are advantages, and unless you have something compelling to offer which is differentiated, which gets me a unique exposure, so this is one thing which makes sense.
So
Eminent.
we'll try our best to turn it into a mutual fund. So we wouldn't have been able to do it without Gift City. I think what
Yeah.
the authorities in Gift City have done in the last 2 years is remarkable. Kabhi or on a separate webinar we'll discuss that. Dhirendra, you have a massive fan club, so सवाल तो आते रहेंगे.
जी.
I'll call it a day today because I've highlighted the book. The book has, believe me, folks, it's easy to read. It has plenty of the answers that many of you are seeking. When some of you want to know what is the discount rate you should use after retirement, very valid question. मुझे भी जानना है, but we can't, make so much. You can't extend the call on Dhirendra's
ये
time.
आप झूठ बोल रहे हैं सौरभ, आप कभी रिटायर नहीं कीजिएगा.
नहीं, अभी जब बाल चले जाएंगे शायद कर लेंगे. अभी कुछ फाइनल स्ट्रैंड्स रह गए हैं. आई थिंक Marcellus PMS has accounted for half my hairline. MF might account for the rest. But jokes apart, thank you very much. It's been great fun doing this.
Thank you.
Thank you, Dhirendra.
Thank you,
Thank you to
Pramod.
all of you. Thank you, everybody. Thank
Thank
you.
you so
Thank you,
much,
sir.
sir.
Thank you.
Thank you.